All right, let's talk about something that's been making a lot of noise. There's this ETF out there. Its ticker is QDTE, and it's flashing a number that, well, it's pretty hard to ignore. We're going to figure out if that number is a golden opportunity or maybe something else. Yep, there it is. A yield hovering around 39%. And if a number like that just made you sit up and pay attention, you are in exactly the right place. We're going to peel back the layers on this and see what's really driving this incredible figure. I mean, come on, who wouldn't be intrigued by that? A nearly 40% payout? That sounds like the ultimate financial shortcut. It feels like the kind of thing that could totally transform your portfolio, so it's no wonder it gets people so excited. But you know the saying, right? If it sounds way too good to be true, you've got to ask yourself, so what's the catch? And for the rest of this explainer, that's exactly what we're going to find out. We're going to unpack the mechanics, the risks, and the reality behind this whole thing. Okay, first things first. That 39% number, it isn't made up. It's a real calculation, and it's based on the actual cash the fund has distributed over the last 12 months. But how that yield gets made, that's where things start to get really interesting. So here's the first huge clue, and you've got to get this. The 39% is what's called a distribution yield. It's just a simple, backward-looking number based on what the fund paid out. It's completely different from the official, standardized 30-day SEC yield, which is supposed to be a forward-looking measure. And get this, at one point, QDTE's official SEC yield was actually negative, at the exact same time it was paying out these huge distributions. That right there is our first big sign that this isn't your typical income stream. Okay, so where is all this cash coming from? How does this income engine actually run? To really understand the payout, we have to pop the hood and see what this thing does day in and day out. That full name is a mouthful, but it actually tells us everything we need to know. Innovation-100, you can just think of that as the tech-heavy NASDAQ 100 index. But the key part, the real magic, is 0DT Covered Call Strategy. 0DT literally means 0 days to expiration. This fund is selling options that expire the very same day it sells them. So when you really boil it all down, its daily routine is pretty simple. It's just a two-step dance it does every single morning. First, it gets exposure to the NASDAQ 100. Then, it immediately rents out the potential gains for that day by selling a call option. The fee it collects for doing that is the premium, and that premium is what funds those massive distributions.
Right, so this engine is a beast, but there's no such thing as a free lunch, is there? This strategy comes with 3 built-in trade-offs, or gotchas, that you absolutely have to understand. They're fundamental to how this works. First up, the capped upside. To get that daily cash, you have to give something up, and what you're giving up are the big home runs. If the NASDAQ has a monster day and just rips higher, QDTE gets left in the dust because it already sold away that potential. It's going to lag a simple index fund like QQQ in a strong bull market. That's just part of the deal. Gotcha number 2 is something called gap risk. This one's a little sneaky. The fund holds its NASDAQ exposure all night, but it only sells the option in the morning. So what happens if some crazy news breaks overnight and the market gaps down at the open? Well, the fund takes that hit. It suffers that loss before it even has a chance to collect a single penny of option premium for the day. And the third and final catch? Low volatility. See, the income this thing generates isn't fixed. It's tied directly to the price of those daily options. And option prices get juicy when the market is wild and volatile. But when things are calm and quiet, those premiums shrink. And those big payouts we're counting on can get a whole lot smaller. Okay, this next part. This is probably the most important thing to wrap your head around when you're looking at a fund like this. We have to look past the shiny payout number and focus on the total value of what you've invested. This is the absolute heart of the matter. It's so easy to get mesmerized by that big weekly distribution, but it is not the same thing as a high total return. Just because you're getting cash in your pocket doesn't mean your investment is actually growing. Look, I get it. It feels amazing getting that paycheck in your account every week. It feels like you're winning. But the cold, hard reality is total return. If the fund's share price drops by 2% and you get a 1% distribution, you've still lost 1% overall. That paycheck was just masking a loss in your principal. And this isn't just theory. Let's make it real. During its worst drawdown, QDTE dropped by about 23%. This proves that, yeah, the income helps cushion the fall a little bit, but it does not get rid of stock-like risk. When the market turns sour, this thing still goes down like a stock.
Okay, just when you thought it couldn't get more complex, surprise, we've got to talk about taxes. Because how these huge distributions are treated by the IRS is not nearly as simple as you might think.
A huge chunk of these payouts can be classified as something called return of capital, or ROC, and you really need to know what this is. It means the fund isn't just paying you profits, it's literally just handing you back a piece of the money you originally invested. It feels like income, sure, but it's actually your own money coming back to you.
So what does this actually mean for your tax bill? Well, it's kind of tricky. The good news is ROC generally isn't taxed in the year you get it. The bad news? It lowers your cost basis. So when you finally sell your shares down the road, you could be staring at a much bigger capital gains tax bill. Think of it as tax deferral, not tax elimination. All right, we've been through a lot here. The crazy yield, how it works, the gotchas, the taxes. So what's the verdict? Is this thing a dream investment, a total nightmare, or is it something else entirely? Look, this fund isn't just good or bad. It's all about the market weather. In a choppy, sideways market where stocks aren't really going anywhere, this strategy is built to thrive. It just collects those high premiums day after day. But in a raging bull market, it's designed to underperform. And in a crash, it's still going to suffer some serious drawdowns. It has a very specific environment where it shines. So, if you're even thinking about something like this, here's your mental checklist, your cheat sheet, if you will. Number 1, forget the yield, focus on total return. Number 2, brace yourself for those payouts to swing up and down. 3, understand the tax headache of return of capital. And most important of all, remember, this is not a bond replacement. It's a stock product with stock-like risk.
So when you see that 39% number, how should you think about it? Honestly, the best analogy is this. Treat it like a weather report. It's useful information, it tells you what's happening right now, but it tells you almost nothing about what the weather's going to be next month or next year. It's just a snapshot, not a promise, and it is always subject to change.